Back with first trades and holding quite steadily on the Nifty right now, above that 26,250 mark, around that mark for now. Sensex also holding up very well. But let's just focus and talk about the NBFC space, a pocket of stocks that have seen major rallies and major uptick in the year gone by. So let's discuss what the growth prospect for that sector looks like going ahead. We have Krishnan Sitaraman, the Chief Ratings Officer at CRISIL Ratings, joining us. They've recently had their NBFC conference as well. Mr. Sitaraman, hi, morning, and thanks for your time. Help us understand, given the kind of run-up that NBFCs have already seen year to date, what is your expectation for growth in the NBFC sector in the days ahead?
Hey, good morning, everyone, and thank you for having me on the show. First of all, I would like to comment that I would not be talking about share price movements. I'll talk about fundamental growth prospects that we see in the NBFC sector. So based on our assessment between this fiscal and next fiscal, we expect the NBFC sector as a whole to see an AUM or assets under management growth of around 18 to 19%. And that will be largely driven by the increased consumption demand, which will fuel retail credit growth. So if you look at a number of tailwinds which are there, we have the GST cut, we had the tax reduction in the initial part of the year in the union budget, we have healthy monsoons supporting rural demand, inflation is benign, interest rates are low. So all these point towards increased consumption. And if October month is any indication, we've seen a good uptick across various consumption-oriented sectors. And that has also resulted in higher disbursements and higher growth. So we expect, while first half was somewhat muted, we do expect growth to pick up in the second half. And overall, we expect 18 to 19% AUM growth. Within that, we believe certain sub-segments like loan against property and gold loans, these would show a higher growth. Whereas the conventional, traditional sectors of mortgages and vehicle finance, they will have steady growth and maybe somewhat below the 18 to 19% that we talked about. We have seen some reduction in the growth in the microfinance segment, where we are seeing a degrowth so far this fiscal. And as far as the unsecured loans are concerned, while we see some uptick, but in the lower ticket size segment, there again, the growth is subdued. So it's a mix and match between various segments in the NBFC sector. Overall, we believe growth should come in at around 18 to 19%.
Right. But Krishnan, how is it that you foresee the asset quality trends panning out for the NBFC sector? And are there any segments which you would want to monitor more closely?
Absolutely. So we again, when I look at a holistic perspective of various segments in the NBFC sector, we don't see much of a concern as far as NPAs or delinquencies are concerned. We do expect some uptick across asset classes as the seasoning happens, as the loan growth increases. Typically, that's what we see. That is a fundamental nature of the business. That said, there are some segments that we are closely and watchful of higher delinquencies. These are segments like microfinance and unsecured loans, where we have seen delinquencies go up from a year or so. The last 1 year, we have seen higher delinquencies. They're actually now stabilizing somewhat in that segment. The other segment where we see some uptick in delinquencies is the small ticket LAP segment, loan against property, the small ticket segment below 20 lakhs or so. We are seeing some uptick in the delinquencies there. And that is something which we will closely watch out for. Otherwise, if I look at, say, the vehicle finance overall, there will be some uptick, maybe 10 to 20 bips increase in the delinquencies. The same will happen in the mortgages. But that is not too much of a cause for concern as far as the overall segmental run rate is concerned. As I said, some unsecured segments as well as a smaller ticket LAP segment is what we are closely watching out for.
Okay, and Mr. Sitaraman, given that we have the policy meeting next week and a rate cut may be on the cards, with interest rates already falling, how do you see profitability trending for the NBFC sector?
Sure. So we have already seen a 100 bips cut in repo rates so far, and our expectation is in the remainder of the fiscal, we should see another 25 bips cut. So typically what happens is when interest rates come down, the borrowings of NBFCs the floating rate borrowings get repriced downwards. And when you look at their asset side, it's largely fixed. for non-housing NBFCs. So for the non-housing NBFCs, typically they benefit when interest rates come down, whereas the housing finance companies, actually it's the other way around, because a bulk of their asset side is on floating rate basis, where the interest rates get repriced when the interest rates come down. Whereas the liability side, there will have a higher fixed component which will stay where it is. So at the initial stages of interest rate cuts, housing finance companies, their profitability tends to come down. But overall, we believe that the NBFC sector will see steady profitability. Our projection is this fiscal, we should see a return on managed assets of overall 2.4%. It was around 2.5% the previous fiscal. Marginal decline is on account of higher credit costs that I talked about because of some increase in delinquencies in some of the sectors. But at 2.4% also, it is a fairly healthy, I would say, return on managed assets or the profitability trend.
That sounds good, and thanks for sharing that profitability number with us. But in a tightening liquidity environment, how are NBFCs planning to diversify funding sources beyond banks and market borrowings, and how would that pan out on the credit cost side of things?
That's an excellent question. See, overall, if I look at the last history of the NBFC sector, spanning last, say, maybe 25 years or so, we see that the funding is a very important aspect which determines their growth prospects, because money is raw material for NBFCs, and the companies which are able to figure out their liability strategies successfully, they are the ones who can see their growth prospects improve. So that said, we are looking at three interlinked kind of dimensions for the NBFC sector in the days ahead, and we are calling it the growth risk funding trifecta. So the NBFCs which are able to have good risk management practices and work out their liability strategy successfully are the ones which will be able to show higher growth. Coming back to your specific question on funding, banks have been historically the largest funding source for NBFCs. If I look at post 2018, the bank exposure or the bank lending to NBFCs moved up from around 5 lakh crores as of March 2018 to around 13 lakh crores as of March 23. Subsequent to that, the risk weights for bank lending to NBFCs went up. Because of that, the bank credit growth to NBFCs came down. And last year or so, we have seen steady bank funding. It is around close to 14 lakh odd crores. It has not gone up after the risk weights were rationalized back in April of this year. What the larger NBFCs have done is they have looked at the debt capital markets, which is bonds and CPs, to raise additional funding. Some of them have gone to the ECB market to raise funding. But the mid and the smaller sized NBFCs have faced greater challenges. They have looked at securitization as a fundraising option, and securitization volumes have gone up in the last year and a half. So that's how the NBFCs are trying to look at diversification. We are hopeful that the banking sector credit growth to the NBFCs in the second half of the fiscal will go up as the consumption tailwinds kick in, and banks would want to kind of leverage the retail credit support, the dimensions which are coming up in the market through the NBFCs, through the mechanisms such as securitization, direct assignment, as well as co-lending.
Interesting. Okay, Krishnan, great to have you on the show. Thank you so much for your time. Good speaking with you.